Hello and welcome. You're watching Business Today Television. This is Market Today. I'm Sakshi Batra and with me is Shail Bhatnagar. Well, it's Friday and yesterday on the monthly expiry day, we actually saw the Nifty hitting an intraday high level of 25,192. So it couldn't have been a better series expiry. And for the week, if you say, the Nifty is already up by over 1.2%. It's now poised for the third weekly advance, and not just that. The Nifty is also up for 11th straight day. The last time you actually saw the Nifty gaining for 11 straight days in a row was nearly 17 years ago, way back in September of 2007. And yesterday's gains during the monthly expiry session was definitely courtesy Reliance Industries, and we've actually seen that 1/3 of the gains were actually being seen by Reliance Industries yesterday. We've also seen, in case we see another positive, in fact, we did see the third consecutive series now. It's the beginning of another one. We'll have to hope to see whether it will be the fourth straight F&O expiry, month as well for the Nifty. And in fact, for today's session, all eyes will also be on another heavyweight. Yesterday it was Reliance Industries, and today it might be HDFC Bank, because it's going to be a big day. MSCI adjustments will take place, which will actually mean some flows could actually come in towards the banking space, and HDFC Bank, which has been an underperformer, will actually see the first tranche of its weightage increase, and analysts are expecting it to receive huge flows to the tune of also almost $1.4 billion as well. So that's something that we need to keep an eye out on as to what Reliance Industries did for the Nifty yesterday. Will HDFC Bank be able to do today? So there's lots more to track today. Good morning to all our viewers, and good morning, Shail.
Good morning, ladies and gentlemen. Lots of exciting things. We are actually at the cusp of history. If we have the 12th successive session of gains, and most likely it will, because there are a lot of positives running behind the Nifty, we'll be making a record of sorts on the Nifty. Ever since it was launched somewhere in September of 1995, that was about 29 years ago, Nifty has never risen for 12 consecutive sessions. Now, if this happens, and why will this happen? You see, Reliance, which is the second heaviest weighted counter on the index, has its board meet on September 5th to finalize the 1:1 bonus issue. Secondly, you have August 30th, which is the last trading session for the month of August, which has actually been flat. If you see the close of July 31st and the close of August 29th, there is just a 0.8 percentage point uptick on the Nifty. So that, ladies and gentlemen, while it seems that the rally has really overextended itself, genuinely it hasn't. We have seen positivity over the last 11 sessions in which the Nifty has added 1,050 points, but overall in the month of August we are absolutely flat. So there are more than enough chances, given the strength in RIL, given the strength that is expected in HDFC Bank, and of course the entire IT pack, you see a lot of momentum. Now that is the reason why I expect a record day. How should I say, we are at the cusp of history, and at least I will have something to tell to a lot of students 20 years later, that this was a time when we were a part of history in the making. Now what else is positive? Look at Bank Nifty, ladies and gentlemen, 51,152. While all other indices such as the mid cap, the small cap, the Nifty 500, the Nifty IT index in particular are rising in great stride, Bank Nifty has stopped falling. And that itself is positivity for the broader market, because financials as a percentage are the heaviest weights within the Nifty. So Bank Nifty is likely to do good. Let's examine the other points that are doing fairly well. You have the Q1 GDP number coming in late evening today, so markets will be looking for some moderation. RBI has estimated that the number will be 7.1%. Any extension beyond that, you will see good moves coming in. It's the weekly expiry of the Sensex, and we'll also look at one major index for today, and I'll request the PCR to fire the Nifty IT index for our viewers. Ladies and gentlemen, it's often said that there is a lot of quietness before the actual storm breaks. If you look at the Nifty IT index, it's had a 4.3% uptick in the month of August alone. It rose 13% in July and 11.6% in June. At the low of June, when it was 31,320, the index has rallied, hold your breath, 11,280 points. That's a 35.8 percentage point rise in 3 months alone. Will the index pause in September? Only time will tell, but the momentum seems to be increasing. What you need to be cautious about is the fact that while the Nifty and the Nifty 500 and Bank Nifty and one or two other auto indices, pharma index and IT index look good, it's the mid caps and small caps that have shown signs of profit booking. Yesterday, both the small cap and the mid cap index trimmed their gains, ended in losses, and had a negative impact on breadth. So one needs to be very, very cautious about what one is doing at trying to buy the market after 11 days of very strong sustenance. So that, ladies and gentlemen, is what we are looking at. Apart from that, we also need to focus on sugar stocks today. A very strong move is likely after the government eased norms allowing sugar and sugar syrup to be diverted towards ethanol. So apart from sugar companies, look at pure ethanol plays such as Gulshan Polyoils as well. This is something that at least I am looking for. Let's again get back to Sakshi. She'll give you cues that are coming in from Wall Street, as of course the quietness that we see on the dollar index, the US 10-year bond yield, and of course the broader markets in general on Wall Street. Sakshi.
Right, so Shail, despite the decline in Nvidia's shares, we actually saw the US markets continue to climb, driven by economic data highlighting consumer resilience. The Nasdaq 100 increased by 1.2%. These developments are gaining significance as investors are now waiting for Fed's preferred inflation gauge due to be published later today as well. The S&P 500 ended flat, and we did see almost a 0.3% lower move as far as the Nasdaq overall was concerned. The Dow Jones ended by about 0.6% higher. It definitely closed at the fresh record high as well. So that was the kind of move that we saw across the board on the US markets. Data has showed that US GDP has grown 3% on the year during April to June period compared to 1.4% growth recorded in the first quarter. Remember, Brent crude was also trading about just 1.5% higher at $79.94 a barrel, and gold was trading about 0.1% lower at $25.17 an ounce as well. Now, as far as the benchmark indices in Asia Pacific are concerned, they rose after stronger than expected US economic data alleviated recession fears among the investors. We did see the Nikkei was up about 0.4%, Kospi was up by 0.7% as well. Hang Seng, 0.5% of gains could be seen there. Shanghai also was up by about 0.1% higher, and the Gift Nifty is also indicating a positive start at 25,288 at just about 0.2% of gains on that front. Now, as far as the overseas investors are concerned, they again turned net buyers of the Indian equities, and foreign investors bought stocks worth about 3,259.6 crore rupees. We did see the domestic institution investors also remain net buyers. They bought equities worth about 2,690 odd crore rupees as well. So that's as far as the macro picture is concerned. Now, looking at some of the stocks that we should be keeping an eye out on. Infosys, keep an eye out on its extended partnership with NVIDIA to introduce high-performance generative AI-powered telco solutions based on NVIDIA NIMs. Great Eastern Shipping or GE Shipping will be also in focus. The company has contracted to sell its 2011 built Supramax dry bulk carrier Jakrani to unaffiliated third party. The vessel will be delivered to the new buyer by the third quarter of the fiscal year 2025. NLC India, the company has entered a joint venture with Rajasthan Rajya Vidyut Nigam for settling up lignite based thermal power plant or station at Rajasthan. This JV is for developing renewable power projects of capacity of 2000 megawatts. Keep an eye out on Tata Motors as well. Remember, it's the final trading session before the capital reduction program record date. Keep an eye out on that. Tata Motors also moved up yesterday sharply in the last half an hour of trade. It ended almost 4.3% higher. Sugar stocks like Shell has highlighted will be in focus after the government has allowed ethanol production from cane juice. So a lot of these stocks will be in focus in trade today. RVNL has signed an MOU with Patel Engineering for hydro and other infra projects in India and in overseas as well. Keep an eye out on that. ITI has bagged the first EVM order from the State Election Commission of West Bengal for 500 EVMs. That's also important to track. Jacob, it's approved 118 crore buyback via the tender route. So keep an eye out on that. The company will be buying back shares at 400 rupees a piece. It's a 2% premium to Thursday's closing price. Record date for the buyback has been fixed at September 10, 2024. NBCC, the board is going to be considering the bonus issue of shares, so keep an eye out on that. SpiceJet has been placed under enhanced surveillance with immediate effect by the DGCA, and this would mean increased in number of spot checks, night surveillance to ensure safety of operations. So keep an eye out on that too. And LIC has got a GST demand, interest and penalty order worth about 605 crores. Keep an eye out on that. And NTPC, the company's unit has commenced commercial operations for 160 megawatt capacity out of 320 megawatts Jaisalmer solar project. Lemon Tree is the last one that I'm going to be tracking. 72-room hotel in Ayodhya is what it has signed a pact for. So keep an eye out on all of these stocks. Shell.
Ladies and gentlemen, Mayuresh Joshi, Head of Equity Research, William O'Neill, India, is with us, a very dear friend. Namaste Mayuresh ji, swagat hai aapka. History in the making. Let's hope for 12 successive gains on the Nifty today, and then the party is either on Sakshi and me. You will have to come to Delhi, or if you invite us to Mumbai, then we are obviously coming.
Morning, sir. Morning, Sakshi. No, you're more than welcome to come to Mumbai. The treat is on you.
देखा किस तरीके से एक ट्रिप बचा लिया इन्होंने दिल्ली का. When he knows the best food is available only in Delhi.
But Shell, he's grown the goatee back for you, and that's why the markets are at all-time highs.
मैंने तो पहले दिन से ये कहा है, आप लोग मेरी बात ही नहीं मानते.
But it's going off today, sir. I've got to be given it.
Mayuresh ji, how is अच्छा ऐसा है, वीकेंड पे कर लेना, आज नहीं. Let the market close, है?
Yeah.
How is sentiment on Dalal Street, my friend?
No, so I think liquidity continues to be strong, Shell, sir. And obviously, I think the mood within retail investors seem to be very, very buoyant. Whenever I meet a clutch of investors who probably missed the rally, they are very, very keen for new ideations. They are very, very keen in terms of participation. And when you look at the SEBI data, and if you dissect through that, I think a lot of the millennials have started entering the market. The only downside risk for this shelter is that the millennials and all those who have entered the market in the last 2 or 3 years have only seen the positive side of markets. I'm not saying that the markets might swing lower. But again, I think kind of flows that are coming through is only with one angle or one perspective that this generation has probably seen. So yeah, liquidity remains strong, sentiments probably remain very, very buoyant at this juncture, but one must remain cognizant of the fact of the evolving macros and micros, and also be a little bit more rational in terms of calibrating your return expectations now. Over the next 2 to 3 years. You won't have every year where you will get a 30-40% return from.
You know, Mayuresh, every generation brings with itself its own set of rules and regulations. While
Right.
we can do all that we can to caution them ahead of potential pitfalls, लेकिन सब अपनी किस्मत का लिखवा के लाते हैं कि कितना कमाना और कितना गवाना है. I can tell you, for 3 decades we have cried enough. Our eyes have dried out looking at the pain in the market. Perhaps this is this generation that will have more fun than what we ever could dream of, and all signs are there, of course with a note of caution. Now Mayuresh, your view on Reliance's AGM and 2 very critical points that you've taken away from them for the next 2-3 years.
So I think the most critical point, sir, was that the new energy business, and that is expected to be more than what the existing O&M business is expected to do. So if you probably look at the EBITDA that is getting generated at around 61 odd thousand crores, if the new energy business over the next 4 to 5 years or within the next decade, before 2030, is expected to generate more than that, you can imagine the kind of balance sheet size that Reliance will possess at the end of this decade. The second aspect is on the new energy vertical itself, whether we are talking about the electrolysis unit or you're talking about the hydrocarbon unit as well going forward. The large part of expectation will now get built in that it will not only suffice a large part of India's domestic need, but it can also come out as a export. It can also come out as an export opportunity. Obviously, the core business and the retail-oriented businesses, a lot of AI-related aspects were spoken about. So I think leveraging technology in terms of existing businesses, whether it's supply chain or whether it's the entire ecosystem that one really manages, I think that will be a huge positive going forward. Because with implementation of such tools, you can have productivity which can go 2 times, 3 times, or even more in the next few years. So I think doubling of revenues on the balance sheet within the next decade is very much plausible looking at the numbers that we're probably looking at right now. And that too in a very calibrated manner, not taking too much of debt, ensuring that leverage remains well within control. Therefore, improving shareholders' return efficiency measured in ROEs. So very, very positive statements coming in from the company itself. And I think realistic ones as well. So if they're able to achieve that, their goal of being in the top 50 companies is not a dream. I think it's an achievable.
Okay. Mayuresh, it's also going to be a big passive FII liquidity day as well with the MSCI index changes also. So we are hoping that India will now go to 20% instead of 8% earlier. And how are you seeing these passive flows going to be impacting Indian markets? We're also keeping a keen eye out on HDFC Bank with the weightage increase there. How are you going to be, looking forward to some key stocks which will be larger beneficiaries of this?
Morning, Sakshi. No, I think Indian markets deserve their share because if you probably look at our market cap and if you probably look at the kind of share that India has at the current juncture in terms of equity allocations, it should at least be 3 or 4 times. Assumably so, even if it doubles from the current levels, just in terms of market share of India compared to the global markets, you can imagine the kind of flows that will come through, both active and passive. So again, I think the point is very simple. Foreign investors cannot ignore India. There might be volatility related to global markets because of which you might see outflows coming at some juncture related to either geopolitics or geo-economic elements. But over a larger periodicity of time, foreign flows have to come sheerly by this logic. Secondly, I think key beneficiaries within the large names. You mentioned HDFC Bank, but there are so many stocks and so many qualitative stocks within the larger names. We were talking about Reliance right now. We're talking about L&T. We're talking about a few banks, IT companies. I think they are very well placed in the entire domestic as well as the global ecosystem. So the flows have to come back. Unfortunately, I think FIs learn the hard way. I think Indian markets are maturing every passing year as we speak. And if they don't stay put with the Indian markets, they might have to enter Indian markets at a premium valuations.
Sakshi, if I had the power, I would shut the markets now. 550 points higher in the pre-open. 25701. Send an air ticket to Mayuresh, bring him over in the weekend. Gajab. 1.94% up, ladies and gentlemen, but you know this will not happen. But what I suggest is that just 1 point higher. Let us close just 1 point higher today. I want to be a part of history. Mayuresh, you would know. 1995, I think you were in college, no?
Yes.
Or you were in school?
No, college. College.
College, okay. So I started working Okay, so from that month in September, when the Nifty started, never has it happened that you had 12 successive days of gains. I only want 1 point out of this 260 that is there, that we close in the positive. Now let's look at stocks. Sakshi mentioned HDFC Bank. Ladies and gentlemen, 5% higher, 81 rupees 1720. Reliance, 58 rupees higher, 3100, record high both of them. Lever, Hindustan Unilever, 30 rupees higher, 2850. ICICI Bank, 21 rupees higher, 1242. Infosys in the green. There's nothing at all that bothers me except for this 2 percentage point downtick on Tata Motors, but all is forgiven because Tata Motors itself is at a record high. Very quickly we'll drill through NSE 500, and it's rare to get Mayuresh, so we'll get back to him very quickly. Okay, मृदुलता की मिठास आपको बाजार में आती हुई दिखेगी चीनी के शेयर्स की वजह से. टॉप गेनर्स 10%, रेणुका 52, त्रिवेणी शुगर 1.5% हायर 445, EID Parry 6% higher 867, sugar again, ethanol equipment maker Praj Industries 4% higher 760. We track 22 to 33 sugar companies for you, ladies and gentlemen. The government's move to ease the process of allowing sugar and sugar syrup to be used for ethanol production has boosted this. Vishwaraj Sugar 8% higher 1980. In fact, all sugar companies are up between 1 and 10%. I won't waste much of your time. Again, we'll get into the FNO space and then Mayuresh for you, ladies and gentlemen. Very quickly on FNO, what is the top gainer? Wow, it's HDFC Bank 5% higher. I think my wish will be given today. Vodafone Idea, ladies and gentlemen, telecom will be in hot focus because the Chief Justice of India will be hearing a curative petition in his own chambers about the plea that telecom companies have taken, that the calculation of adjusted gross revenue to pay a percentage of license fee is incorrect. Should that be accepted, you will have a massive rally, at least in Idea Cellular. Manappuram Finance 2% higher, Lupin 2.3% higher, and of course TVS Motors. So ladies and gentlemen, everything is fine in the world of Dalal Street. 218 points higher, 25,360. Will this attract option sellers? Only time will tell, but for the moment let us enjoy this wonderful space with Mayuresh. Now Mayuresh, your life becomes to get more difficult. More people will come into the market and trouble you for better stock ideas. I already have a list of your stock names that you have suggested. What are the ones that you want to add today?
So I think one, continue with the list because our take is that earnings should remain strong. And before that, I think congratulations, Shelter and Sakshi. I think for new record highs that we'll make on the index. Both of you have been instrumental in terms of guiding a lot of investors into the market. Staying in the market from 9 o'clock till 4 o'clock on air is very difficult. I can understand for 30 minutes and I get out of air speaking about the market, but it's a difficult job you guys do, so hats off to you guys. When it comes to the stock itself, I think one of the stocks that we are liking from a medium-term perspective is Nesco. Our take, Shelter, here is if you probably are a Mumbai resident and you have been passing through Goregaon, you will see the Nesco land. So they have got an IT park, they've got Bombay Exhibition Center, they've got their intra-pater business, and they've got their foods business. The foods business is coming back strongly, but two of their biggest assets in terms of brownie points are their IT park and their Bombay Exhibition Center. Now the expectation is that once this quarter is largely over, you're going to see a slew of events that are probably expected to happen. They continue over a periodicity of time. So the IT park revenues, both in terms of top line and EBIT, are improving at a good pace. The Bombay Exhibition Center revenues and EBIT are improving at a good pace. They are sitting on a decent amount of cash as we speak, so balance sheets remain extremely strong. And now the best part, if you probably look at the land area for both the IT park and the Bombay Exhibition Center, what they have actually consumed for the IT park is just 14%. So there is an FSI which is available for development of 85%. for the IT park and almost 80% for the Bombay Exhibition Center itself. So there is huge amount of scope in terms of growth, specifically in the land scarce area like Mumbai, which can be put to use by Nesco for development on their own, for joint development, or any other purpose as well. So to that extent, I think valuations are not very, very expensive. Earnings expected to remain very, very strong. And the balance sheet itself remaining strong with good cash flows means ROE should remain extremely vibrant as well. So one of the ideations that we're probably liking at this juncture, looking at valuations and earnings, is Nesco.
All right. Well, thanks for all those kind words, Mayuresh. Congratulations to you as well. And now we are joined by another special guest on board. We have Shibani Sarkar, the Senior Executive VP, Fund Manager and Head at Equity Research, Kotak Mahindra AMC. Warm welcome to you, Shibani. So good to have you with us on this morning when we are seeing another set of record high levels on the Nifty. And, just like how Shail pointed out, we may be a part of history in the making. Probably if this turns out to be true, it will be 12 straight sessions for the Nifty to end in the green, and that would make it a record since the time it got, into operations in 1995. So how are you looking at all of these scenarios now playing out?
Hi, good morning. A pleasure to be on the show as always. So yes, it's been a great ride for Indian equity markets over the last few years. So when you look at markets today, some of the key factors that have been driving markets are still fairly intact. So macro continues to remain strong, especially in context of what's happening across the globe. The second important factor has been earnings, and we've spoken about earnings on the show before as well. If you look at what has happened in the first quarter of FY25, earnings have been largely in line with estimates. However, estimates itself were muted, right? The expectation is now that for FY25 and 26, Nifty will still deliver somewhere in the mid-teens in terms of earnings growth, which means that the onus now lies for the remainder of the year to see a pickup in terms of earnings. And I think that is going to be very key for the markets, specifically in the second half of the year, as it coincides with the festive season. So that's going to be one key factor to watch out from a market perspective. We must also keep in mind valuations, and if you look at valuation parameters, clearly risk reward continues to favor large caps over mid and small caps. The way we are approaching the entire basket of mid and small caps is to look at companies on a more stock specific basis. Look at companies where earnings are still intact but valuations have to be reasonable, and avoid segments where the free float is low, where multiples have moved up in excess of earnings growth, which has contributed to the price movement. So that's one segment where we are fairly cautious on. Now, of course, given this kind of ride that we've had in the markets, it's possible that near term we see some consolidation or volatility. However, as long as earnings and macro remains fairly stable, especially in the relative context, we don't see any sharp drawdown in the market, but some degree of volatility, specifically with global events such as the Fed, geopolitical risks. Some of that should maybe play out in the near term, leading to some near-term volatility. But overall, we believe that the market dynamics remain fairly intact from the medium-term perspective.
Good morning, Shibani. And from now on, you are our lady luck. If the market closes in a record high, as it should, and make history, then obviously you'll have to come on a fairly regular basis to sort of keep that lady luck running on the show. But I'd like you to wear your research head now. As I was pointing out to Mayuresh, that life has become difficult for stock pickers and market analyzers such as you both. What now? Everybody and his 7 previous generations now want to participate in the market. And they have liquidated everything. Third homes, fixed deposits, gold, sab paisa yahi aa raha hai. That makes it difficult for you because we have to sort of keep sense and sensibility in our stock picking. So what are the areas where you feel relative valuations are still cheaper or inexpensive, if I may say, with the other sectors? IT was something that we were sort of trashing for 2 years, and in the past 3 months itself the index is up 36%. pharma at a record high, auto at a record high. So where will fresh inflows go in?
So absolutely, this is something that we discuss and grapple with pretty much on a daily basis, trying to find pockets of reasonable valuation, as you were asking. So when you look at sectorally, the theme that we have played over the last few years has been the entire capital goods, manufacturing, and industrial space. Now, while we continue to be positive on the theme on a medium to long term basis, we also acknowledge that in parts valuations have become stretched. So from that perspective, some of the other sectors that we are looking at and evaluating, where we still find that valuations are reasonable, there may be some improvement in terms of fundamentals as well, are threefold in nature. So first and foremost is the entire consumer basket. So again, if you look at consumption in India, post-COVID, consumption has been pretty much led by the premium segment, while rural and affordable or the mass segments have lagged. However, at the margin, we do believe that if you look at commentary from companies, specifically post the first quarter earnings season, where rural seems to be moving up, trends in terms of rural wages on a real basis also seem to have bottomed out and are now moving up. And of course, the monsoons have been good, which means that the crop output in October from a Kharif perspective should also be fairly good, all adding to some improvement where rural demand and mass demand is concerned in the consumption space. Here we find valuations in context of history fairly reasonable, and this is one segment that we have incrementally looked at. The second aspect you correctly mentioned was the tech space, where the sector was beaten down for a fairly long period of time. Today, from a valuation perspective, we do believe that large cap tech still offers valuation comfort, with the Fed possibly looking at cutting rates and the US possibly heading for a soft landing. We should see some of the discretionary spends on tech come back, which again bodes well for the sector. And the third sector where valuation and risk reward is still favorable is banks, specifically some of the larger private sector banks, where multiples are significantly lower than the history. Near term, there are a few headwinds in terms of margins and interest rates possibly coming off, as well as the liquidity coverage ratio guidelines, which could also impact margins. But I think that valuation and risk reward from a medium to long term perspective on banks is also fairly favorable. So these are three sectors where we believe that value still is there, and these are segments that we are incrementally evaluating.
So Shivani, on HDFC Bank, clear question right there. What will investors do now?
Unfortunately, I will not be able to answer specific questions on a bank or a particular company. However,
Okay.
if you look at the private sector banking pack, the sector has seen improvement in terms of return on equity over the last 3-4 years. Near term, there has been pressure on margins because, as you know, deposits in terms of growth have been lagging credit growth, and therefore there has been pressure in terms of cost of deposits, which has also factored into margins coming off, which is the net interest margins for banks. However, having said all of that, incrementally we believe that with liquidity possibly improving in the system, the pressure in terms of margins should also start to bottom out. As we were discussing earlier, when you look at valuations for the entire private sector banking pack, valuations are significantly below their long-term average multiples. We do believe that this segment will continue to gain market share in terms of credit as well as deposits. And therefore, as things start to improve from a profitability perspective over the medium term, this sector looks fairly attractive and risk reward appears to be favorable.
Right, ladies and gentlemen, just at the cusp of market opening, we have two very smart people with us. We'll very quickly look at in the markets and get back to what is turning out to be a great discussion on where to find value. Needless to say, a record high, ladies and gentlemen, 25,250 is with us, 94 points higher on the Nifty. The Nifty Bank is on a tier, already 0.5% higher, and that's because of HDFC Bank, 21 rupees higher, 1660. IT index 47 points higher, and hold your breath, Nifty 500. This is the one that I look very deeply into. 100 points higher, 23,736. Needless to say, this is a record high. A very quick look in the advanced decline ratio. Okay, it's a blowout. 1400 shares in the green, 250 in the red. We track 19 indices for you, ladies and gentlemen. The blowout starts with Nifty Realty, 1.5% higher. All 19 of them are in the green. The mid cap is up 0.5%. The small cap index is up 0.6%. Let's hope this continues. A very, very quick look into what's happening on Reliance. 15 rupees higher, it heads into a 1:1 bonus, which the board has to agree by September 5th. Sugar. Balrampur Chini, record high, 627% higher. Mayuresh was with us on 16th of August. He had recommended Praj Industries, the third most top gainer, 5.5%, 770. Triveni, 5.2% high. In fact, 7 out of the top 10 gainers on NSE 500 are sugar. Let's get Mayuresh into the conversation. Mayuresh, any mid cap or small cap that you find attractive at current levels for a 2-year time frame apart from Nesco?
So to that extent, Shail sir, I think very few pockets, as Shibani was also mentioning, where valuations and earnings, that typical matrix should be working in favor. And therefore, I think our take is that selectively, a few of these auto ancillaries might also do well. Yes, autos might probably just languish a tad bit in terms of expectation of earnings for this fiscal. But a large part of expectations of slew of new launches coming through in the second half should start auguring well as far as the next year is concerned. So within the auto ancillary pack, our own sense is that a stock like Recall, as an example, where the balance sheet probably looks strong, where the expectations in terms of orders from the electrical mobility segment should hold up pretty strongly. They've been adding more orders incrementally through the EV platform segment, and that will be with better margins. And therefore, I think the mix that these ancillary companies have of servicing internal combustion engine makers, the OEMs, the expected electrical mobility platforms, both in terms of two-wheelers, four-wheelers as well, and the huge replacement market that they're catered to, where pricing probably remains in their favor, and where leverage is probably not exceeded. I mean, it's a very, very negligible leverage that they carry on their balance sheet. Means that earnings should probably remain stable. But you have to take the next 2 to 3 years, assuming this year might be a little bit of a sluggish year, both for autos and auto ancillaries as well. So Auto Anc as a space and as a pack looks decently placed. Recall is something that we also carry in our long-term focus ideation process.
Okay, auto ancillary space and pre-call, we'll continue to keep an eye out on that. Oil and gas space is rallying 1% higher for the index. Stocks like Oil India, 3.6% higher in trade. BPCL is now moving to the top spot as far as the Nifty movers are concerned, 2% higher. HPCL, GAIL, IOC, Indraprastha Gas, oil and gas is clearly buzzing. Let's get Shibani into the conversation. How are you looking at this energy pack, Shibani, and how are you advising investors to go about this?
Yeah, so this energy pack is fairly interesting. From a valuation perspective, the pack looks still fairly reasonably valued. The way we have approached the sector is that we've looked at companies which are in the gas transmission space and utility companies which still have scope for volume growth as the share of alternative fuels and gas in the entire India's energy basket increases. From an oil price perspective, we've seen that price has remained fairly stable and within a range. However, there has been some degree of volatility for OMCs as far as their marketing business is concerned, and that depends upon how oil price really pans out. Regional refining margins is something that we will have to keep a watch out for. But for the overall basket, we believe that the basket does offer opportunity, especially where the transmission segment on the gas utility space is concerned, given that we do believe that, in terms of volume growth, this is a space where volume growth would likely continue. And therefore, we do have exposure within the oil and gas space, where again, pockets valuations look fairly reasonable in the context of where markets are.
Shibani and Mayuresh, this is a question for both of you. Shibani, first you, because you handle a lot of public money. On a net basis, in the last 1 month or 2 months, have you raised more cash in your overall portfolios? And is taking a cash position a strategic call? Because globally we hear about this mad fear. I don't know where that fear is coming from, Mr. Buffett is moving into cash. Everybody who has a PMS worth his salt has higher and higher degrees of cash. And here is a market which is just not reacting at all. So, what is your position on cash over 2 months? And what do you feel? Is it a useless exercise to remain in cash given the way markets are moving?
So, as a philosophy, as a fund house, we typically avoid taking cash calls. So, for us, cash is not an asset allocation tool within our equity funds, and therefore, you will see that cash typically ranges in the overall average range of anywhere between 2 to 5%, primarily for liquidity purposes. So our philosophy has been that we are equity fund managers, and therefore, from that perspective, we usually do not take cash as an asset allocation call, as I mentioned, across our portfolios. So no, there has been no major change in terms of cash positioning across our portfolios. Of course, within the portfolio, we do try to find sectors where valuations are reasonable, earnings trajectory is comfortable, as we were discussing. But overall, last 2 months, there has been no change as such in terms of our position on cash across our portfolios on the equity side.
Okay, Mayuresh, your take on this, mad rush for cash, and the markets are adequately punishing all those guys. 20% आपके PMS में cash है, और there is no looking back on major indices. How do you react to this thread in the market?
So I think one side of the argument, Shelter, will always be that there is less availability of capital to be deployed. So more capital is always welcome in the markets like these. And obviously, I think in a bull run, the sentiments obviously run high. But obviously, I think it really depends in terms of your risk reward as well. If you are a conservative investor, obviously you will pay heed to valuations, you will pay heed to which sectors are probably looking a little bit on the higher side as far as the standard deviations, as far as forward multiples are concerned. And therefore, you might be sitting on some element of cash, waiting for your favorite sector to probably come down to reasonable levels as well as reasonable valuations. Now, in markets like these, which are fueled by liquidity as well, it is impossible to say whether a dip will come, and if that big dip comes, which we've seen in the last 3 years, Nifty has corrected 5% on multiple occasions, but not more than that, and that has been quickly bought into. So if somebody is waiting for a structural dip, a structural downside, that is probably not happening at this juncture. And therefore, I think being reasonably placed into the market and being cognizant of what is happening around you to the best of our abilities, both in terms of macros and micros, is the best we can do. The initial signs that we probably see in some sectors when growth is building up, you can probably come out of that, stay on cash for some limited periodicity of time in markets like these, and probably hunt for sectors where valuations are a little bit in your favor. But to that extent, I think being invested in the market is the mantra at any point of time, because you're not looking at the markets from a month, 3 months, 6 month perspective. It really got to be 4 to 5 years. The markets will give you your desired returns based on your return expectations. Which again, as I said in my opening remarks, should largely be now calibrated. We've seen only the best part of the market over the last 3 years, but one must calibrate the return expectation over the next 2 years.
Right. Well, apart from this, Mayuresh, how are you looking at the real estate space? Again, the index is up over 1%, and we are at the helm of September, and this is going to be the most crucial month because we are going to be looking forward to Fed's rate cut announcements, and that would make way for even Indian Central Bank to look forward to a rate cut cycle going forward from here. How would you look at the real estate story build up?
So Sakshi, again, I think the real estate cycle is in real earnest. The 6-7 year cycle, we're probably in the 4th year, as all of us have been speaking ad nauseam. A large element in terms of the developers per se and the commentaries thereof have been very, very positive, and the numbers have been probably justifying that. But let us now assume that the last 2 years, they are coming off a very, very heavy base. And therefore, the good times will continue. You are seeing launches still happening. The pre-launches are getting sold off in select key pockets. And that enthusiasm still might continue over the next couple of years. Obviously, the fence sitters, with rate cuts also expected in the Indian context, might take and grab that with both hands. We were just discussing a couple of days back with our US team, and our take was if you leave aside 2001 and 2007, when the rate cut cycle was initiated, but those were different conditions. These conditions are not showing any liquidity stress per se, as global debt to GDP has moved up. But a large part of the mortgage market, even in the US, might even move higher in terms of more debt with interest cuts happening in the US. A similar story might play out in the Indian context as well. And therefore, numbers will keep on stacking up for developers as we speak. But the real estate ancillary space, Sakshi, again, I think looks a tad bit more attractive at this juncture. They have gone through their periodicity of pain the last couple of years, both in terms of inflation, in terms of their input costs, as well as volumes not picking up to the desired extent. But as new homes are getting constructed over the last 3-4 years in the real estate cycle, as refurbishment happens in the existing homes, many more projects going in for redevelopment, I think this space is now very, very interestingly poised. The input costs have now remained stable. Volumes from management commentaries are indicating are showing signs of picking up. And as that volume pickup starts happening with better realizations, input costs remaining stable, operating performance improving, showing operating leverage, and therefore bottom line growth, ancillary players within this space might be a little bit more attractive. So I think a little bit skewed towards the real estate ancillary space, Sakshi, compared to the developers at this stage.
Shivani, how are you reacting to these developments in the market about IPOs getting super hyper oversubscribed? Premier Energies has an demand for more than 1 lakh crores. The last time it was seen on Tata Technologies, and we've seen that disappointment for the last 8-9 months. A Delhi-based company got a demand for 4,500 crores against a demand for 11 crores. And what talk about Ola? So when all fund managers sit together on the morning table and discuss what to do you look at these numbers with a breath of wonder, or how are institutional guys reacting to this kind of a frenzy?
So you're right, absolutely. So if you look at the supply that has come through, obviously all of that supply has been more than absorbed over the last 1 year, and that has resulted in a lot of these IPOs, as well as the stake sales that have happened either from the promoter level or from private equity. All of that has pretty much been absorbed into the market, and it is also likely that going into the next year there is a slew of more issuances and supply that is possibly lined up, and we'll have to wait and see how demand really picks up in terms of absorbing this supply. For us, I think what we have done is to keep our heads very, very stable in terms of how we approach these IPOs and these companies. The entire fundamental framework that we apply for any investment remains fairly intact when we are approaching investments into IPOs. We are clearly looking at companies on a threefold basis. First and foremost, in our approach, we are looking at companies where these companies are either market leaders in their segments or sub-segments, or companies where there is sign of market share gain, and that gain has to be scalable and sustainable in nature. Second most important factor when we evaluate all companies, including IPOs, has been corporate governance practices and accounting standards and disclosures. And this has been one of the cornerstone of the way we research companies, and that continues to remain the focus in terms of management quality, their ability to deliver, as well as accounting standards and practices under that head. The third aspect for us has, of course, been valuations. We are very, very cognizant of the valuations. We believe in the philosophy of buying growth, but at a reasonable price. And therefore, for us, valuations have to be looked at in context of cash flows, return ratios, as well as earnings trajectory going into the medium term. So I think these three factors have helped us in terms of, look through some of these IPOs and the supply that has come, and be selective in terms of where we are looking at incrementally investing our money.
Okay, continuing the same question to Mayuresh as well. Mayuresh, remember just a few months ago we were all talking about how the small and the mid cap space were in an increasingly frothy space. The SEBI came out with a lot of statements talking about a lot of valuations overheated right there in this space, cautions coming in, and now that caution is shifted to the SME IPO space as well. Do you see this as the biggest risk right now for the domestic equities, which are on a fine fettle right now? And that may be a risk that investors should be watching out for?
Oh, absolutely. In fact, the feeling of missed out as we speak to a lot of ultra China investors or even retail investors to a large extent is very much existing, Sakshi, in the markets. And therefore, as I said, a lot of investors are hungry at ideas and they might look at any mediums to find those ideas. So one caution note, I think, just don't follow anyone blindly in terms of ideations on social media. Do a little bit of your own diligence and research, which your own hard-earned money that is probably getting in. Few pockets within the broader markets, yes, I think the froth has built up quite significantly. SMEs is one space that I never understood, Sakshi, because it is a space where market making is of paramount importance. Whether there are numbers which are justified in terms of the upticks that you probably see on the listing date itself, a 90% uptake, a 100% uptake, and still I think there are arguments put forth that the stocks are still very, very reasonable. I just don't understand the space, and because I don't understand, I don't venture into the space at all. But even within the broader markets, as far as the NSE 500 is concerned, a few pockets are looking frothy as we speak, and therefore I think the mantra is to look at quality within the broader market, look at stocks within the mid-cap space which have leadership position in the domains that they are working out of. And those pockets and those stocks might still be resilient enough if there are certain shocks to the system, if one might witness that going forward as well. So again, the mantra is very simple, stick to quality, stick to leadership.
Okay. Before we let you go, Mayuresh, I'll request the PCR to put all 4 windows on a single frame. Most likely this is going to be history in the making, Shibani. We'll end 12 successive days of gains on the Nifty, and since 1995, when Mayuresh was in college, Sakshi was probably in 5th standard, and I had entered the markets. This is something... Kindergarten. Okay, I'm so sorry. Sakshi was in kindergarten. My sincere apologies. So we have to be very careful about such things. So kindergarten for Sakshi, college for Mayuresh, my first year of work, and a history in the making as far as markets are concerned. My final question to you, Mayuresh, before we bid you goodbye on Friday, is where will the Nifty be 1 year from now?
$1 million question, Shail sir. I hope it touches 27,000. 2 plus 7, 9 is my lucky number.
क्या बात है, तो 27,000 ladies and gentlemen, कर लीजिए तैयारी. And Mayuresh, thank you so much for what has been a wonderful chat. I have added 2 stocks to your list, Nesco and Precol. You were with us on 16th of August when we talked about Praj, Capacity Infra, Welspun Enterprises and Welspun Corp, and to this tally we add 2 more today against your name. Thank you so much for your time, and it is always such a pleasure speaking to you.
The pleasure is all mine, sir. Thank you so much.
Thank you
so much.
Okay. Yeah. And Shibani, let's carry this discussion forward. You've spoken on the whole breadth of the market, and we've missed one major macro, which is today's Q1 GDP, and of course this impending rate cut on Wall Street, September 17th and 18th. How do you see both these macros impacting markets on Dalal Street over the next, say, 6 to 9 months?
Yeah, so if you look at what's happening as far as the US Fed is concerned, when we started the year, there was expectation of 5 to 6 rate cuts during the year. Then that number dwindled down to 0. And now we are possibly in a situation, given the latest commentary from the Federal Reserve, that September seems to be the likely start of the Fed rate cut cycle. So from our market perspective, two things are important to watch out for. One is, of course, does the rate cut coincide with US GDP coming off in a big way? If the scenario is that of a soft landing along with a rate cut cycle, then that bodes well for emerging markets on the whole. The second aspect to watch out for, of course, will be what happens with interest rates in India and when does RBI follow suit. For RBI, I think the most important factor for them, and as they have been articulating, is to bring inflation down to 4% on a more structural basis where India is concerned. And therefore, RBI will possibly wait and watch and see what is the trajectory of rate cuts in the US and the data coming through. Because as you were rightly pointing out, that growth in India continues to remain fairly strong and stable. And as inflation is moderating, there is no pressing need for rate cuts at this point in time. However, RBI will possibly take a view and follow suit, but with a lag as far as interest rates and monetary policy in India is concerned. And that's what we are building in as far as markets go from an equity perspective.
Right. Now, Shibani, you know something that I was also asking Mayuresh, the small and the mid-cap space, how are you spaces now? Is a lot of the froth already out? Is it in a comfortable zone, or is it still something that you will not touch with a barge pole right now?
So it's not that we will not touch small and mid caps. There are pockets of opportunity within small and mid caps. It's just that you have to be very, very stock specific. There are froth in pockets, especially where small and mid caps are concerned. If you look at just at valuations at a headline level, the Nifty small cap index as well as the mid cap index are trading at a premium to their own history, and that premium is almost 40 to 50% premium. And you compare that with Nifty 50, which is the large cap index, which is trading at about a 14 to 15% premium. In terms of contribution of mid and small caps to the overall market capitalization of India, we are at an all-time high, while large cap contribution is at an all-time low. So any parameter that you look at, whether it be mid and small cap, market cap to GDP vis-a-vis history, valuations are looking elevated. As we were discussing in the earlier part of our conversation, there are pockets where prices have moved up, but most of the price movement has been contributed by PE or multiple re-rating and not by earnings growth. And therefore, those are segments within the mid cap and small cap space where we will be very, very cautious. We will also be cautious in segments where the floating stock or the free float is low, and therefore again price movement has been led mostly by multiples moving up rather than fundamentals supporting it. So our approach to mid and small caps has been stock specific. There are pockets of opportunity, but we have to be clearly mindful of valuations, and valuations continue to remain elevated where this segment is concerned.
Okay, Shibani, let's look at two segments of the market, defense in particular, where we've been at the receiving end of perhaps the most potent of topping out signals, sector specific funds being launched, as also the broader PSU theme, which was resonating very well till about 2 months ago. Now, is everything done and dusted, or do we see a resurgence of these two sectors coming back maybe 2 or 3 months from now? On the valuation chart, where do defense stand, and how do you sort of now look into PSUs?
Yeah, to answer your question first on defense, as a theme, we do believe that the theme remains intact. The entire order book in terms of growth, both from indigenization of defense as well as the export opportunity, which is opening up in a big way. For most of the companies, the order book and the numbers that came out, especially after the first quarter, the numbers continue to remain fairly healthy, which means that there is runway for growth and the visibility of growth is intact. As you correctly pointed out, the main factor to take into account is the valuation. So at the margin, valuations for the sector have run up considerably, and therefore near term, while the sector thesis remains intact, it is possible that the sector does see some degree of consolidation simply because valuations are expensive. The second question that you had is on PSUs. We've always maintained that when you look at PSUs, you need to look at it segment to segment and stock specific in nature. Now, within the PSU basket, there again have been a number of stocks where essentially you've seen that the free float has been limited and valuations have moved up primarily ahead of fundamentals and ahead of earnings. So multiple re-rating has contributed to the price movement. So that is a segment which we've clearly stayed away from. If you look at the PSU from a sectoral perspective, there are still some pockets where valuations remain reasonable. Oil and gas is one space within the PSU pack, as we were discussing in one of your earlier questions, where there is some degree of valuation comfort and there is growth opportunity, especially where it comes to gas utilities, gas transmission, and the likes. The second segment where valuations still are reasonable is the PSU banking pack. Again, while there has been up move in valuations over the last 2 year period, there has been a period of consolidation. So on a relative basis to the market, we do believe that banks as a whole pack, as well as within that some segments of the larger PSU banks, where valuations remain reasonable at this point in time. So we are looking at PSUs on a more stock specific and sector specific approach rather than just a generalized basket in terms of how we are positioning it in our portfolios.
Shivani, pharma has recently done pretty well and it's come back after a long haul too. How would you really look at the pharma story building on from here on? Would you be an incremental buyer in the pharma space?
So pharma as a sector has done reasonably well. Again, if you look at the sector, we have to divide it into three pockets. First and foremost is the US generics business. This business and segments which are in this particular space have seen improvement, especially because price erosion has come off materially. So we are now looking at low single digit price erosion. There have been a slew of approvals which companies have seen coming through, and that has led to improvement in terms of top line growth, along with improvement in terms of margins. And therefore, the sector has seen very strong earnings delivery, and that is now reflecting in terms of valuations up move. Here, we believe a lot of the valuation catch up has possibly come through, and therefore, while the sector will possibly continue to deliver on earnings for the next few quarters, but valuations are also reflecting the same. The second aspect of pharma is the domestic pharma business or the domestic formulations piece. Here we believe that growth is likely to remain steady, low double digit kind of growth. And here there are pockets of opportunity, both companies in the acute space as well as companies which are in the chronic segment. And this is one space where we are fairly positive on a stock specific basis. The third aspect is the healthcare hospital segment. Here again, there are pockets of opportunity. The universe of stocks within the segment has increased quite a bit, and there are far more opportunities to look at within the healthcare hospital space. This segment has also seen improvement in terms of growth and profitability. And here we believe that there are again pockets where valuations are reasonable. So within the pharma basket, the domestic business and the healthcare hospital space is something that we are looking at on an incremental basis.
Shivani, another sector that's perhaps still not lived up to its potential is the smokestack space of textile companies. There is turmoil all around the Indian geography. Bangladesh has issues which recently came up, Sri Lanka 2 years ago, and of course the crisis in Pakistan. It's the main cotton growing area in Southeast Asia. How do you see this sector? Does it have long-term opportunities to create a very decent wealth over the next 2-3 years? And any picks within the textile space that you can share? Exporters, yarns, integrated mills. What looks good?
Yeah, so I think of course, the sector is small in the overall context, but there are a few key factors to watch out for. One is the recovery in the end use market. There is some amount of demand that is coming back, especially because of restocking by US apparel players. And from that perspective, some of the Indian exporters will be a key beneficiary. In FY24, this sector saw significant volume decline. And now incrementally, we are starting to see early signs of recovery, which will possibly likely continue going into FY25 as well. From an Indian perspective, of course, Indian players, which possibly because of what's happening on a global context, can gain market share, and that is something that we will have to watch out for. Overall, what we believe is that operating leverage will be key in terms of driving improvement in profitability for the sector, which has seen a significant headwind in the last year or so. So at the margin, we do believe that there is improvement that is taking place for the Indian garmenting players, especially for those who are part of the export story, where we are starting to see some improvement in demand, especially in the end use markets.
Okay. One more space that I wanted to draw your attention, Shibani, is the new age internet space. Of course, we've been talking about a whole host of stocks here. Zomato is, of course, one of the stories that everybody has tracked, how the stock has doubled. Now we have other stocks that are pulling up, PB Fintech, Paytm, Nykaa, Mama Earth, you name it. Some of the stocks are actually coming off their low points as well. Valuations are slightly better off than what they were earlier as well. How are you looking at the new age internet space? Is that a space where you're looking at more favorably now? How should an average retail investor now look at some of these stories?
Yeah, so I think when you talk about new age internet space, one must remember that every business model has to be evaluated on its own merit, because these are not homogeneous models, they're heterogeneous across
Yes.
different segments and different industries. So there are three, four key factors that we are looking for. First and foremost, the existing industry in which the company is operating in, what is the market share, what is the total addressable market, and what are the entry barriers in terms of competitive intensity in that particular market. If, for instance, it's a market where the TAM, or the total addressable market, is large, the competitive intensity is under control, and therefore there are entry barriers to new players coming in, that means that this market is such that the existing company can gain market share and maintain market share. This is one pretty big element in terms of how we are evaluating some of these new age internet companies. The second aspect, of course, has to be path to profitability, margin improvement, and finally delivering in terms of bottom line. And therefore, path to profitability has to be one of the key elements in terms of how you evaluate this company. And the third aspect, most importantly, now that these companies are listed in the public space, is capital allocation and how these companies are approaching minority shareholders and protection of minority shareholder rights. And therefore, these are key factors to look at. How will capital be allocated? Whether capital is easily available to these companies? Can they gain market share? Can they defend their market share? And most importantly, what is their path to profitability? These are first a few factors that we are looking at when we are assessing some of these new age internet companies, and then taking a view in terms of stocks on a specific company specific basis.
Shibani, have you nibbled into any of these internet plays over the last 3 months?
So I will not be able to discuss specific on portfolio, but of course our portfolio disclosures are there on a monthly basis. So as we said that it's not that we've not evaluated and we've not looked at this space. There are definite pockets of opportunity within this space. We believe that this is a segment which can see significant growth. Most importantly, I think that with many companies now coming into the public space, these companies are more and more focusing on profitability, and therefore it's not growth at the cost of profitability, but it is growth and profitability which has been the strategy. And that's the change that we have noticed over the last few years since the companies were listed initially, where the focus was more and more on growth, but it came at the cost of profitability. But now we've seen a significant shift across a few of these companies within the space, where capital allocation is also very important. There is a path to profitability which has been enumerated by the companies, and also growth, which is of course one of the key drivers for valuation within the space.
Right, and our final question, Shibani, to you is, the jury is still out on the chemical space. Vast swaths of the Lal Street are in this pandemonium for frenzied buying, but what's missing out is the chemical space. Has the cycle turned for the better, or do we see worse days ahead?
No, I think the cycle is possibly coming close to a bottom. It has still not bottomed out. So if you look at what happened in the chemical space, there were twofold which impacted the entire space. One, of course, the supply element from China, and therefore significant amount of dumping which impacted prices. The second was demand itself has muted at the end markets, and therefore there was a lot of demand-led headwinds which impacted the overall space. Now, from a demand perspective, what we are seeing is that the headwinds on demand seem to be bottoming out. Domestic demand has started to improve. Globally, demand possibly has bottomed out, and you will start seeing some of that restocking cycle starting to play out. However, the supply element from China continues to remain fairly high, which is impacting prices. And therefore, it is possibly some time when the price recovery will be visible. Our view is that while possibly we are close to a bottom, we will possibly see 1 or 2 quarters more of pain and then things starting to improve, especially in the second half of the year. This is a segment, in context of your earlier question on valuations. Valuations are reasonable, especially given where they are in terms of their history. However, we will have to wait and watch maybe for another quarter or two for some of that recovery to really play out. So we are keeping a fairly close watch where this sector is concerned.
Right, Shibani, thank you so much for this lovely 45-minute chat. It's been an extremely educative 45 minutes, at least for me, and I'm sure for Sakshi and our viewers as well. Before we let you go, your final view on what the Nifty could be 1 year from now.
So of course, I will be very difficult for me to take a specific number on the Nifty. But I think the way the markets have been in the last year, year and a half, one must also moderate some amount of expectations in terms of market returns. I would say that when you look at earnings delivery, I think that is going to be the key driver for markets going forward. From a consensus perspective, earnings numbers for FY25 as well as FY26 remain fairly intact. So about 12 to 15% earnings growth expectation, which is intact, which is very important in terms of delivery for the market to continue on their path to sustained movement in the medium term. One factor I must end my conversation with you in is that while markets could be volatile in the near term, especially given the run up that we have seen, some of the global events, specifically geopolitical events, which could have a bearing on the market. But as long as macro remains strong and as long as earnings delivery remains strong, especially second half of the year, where we expect to see improvement in terms of earnings, any kind of consolidation or drawdown will also be limited. And therefore, we do not expect to see any sharp correction in the markets going forward. However, one must also moderate expectations given the fact that we've had a great couple of years where markets are concerned.
Okay. Got it. Well, thank you so much, Shibani. It's been an absolute pleasure to host you on Business Today Television, and what a fantastic, conversation we've had. Turns out to be we can put this out as a masterclass on its own. The questions we asked and the answers you gave will benefit a large part of our viewers as well. So thank you so much for giving us, with absolute clarity as to what should be done when the markets are at an all-time high and how to keep heads calm and at the same time be away from any kind of FOMO as well as, at this point in time. Thank you so much. Appreciate your time. And like Shail said, that you are our lucky mascot. So please do keep coming so that we can celebrate more milestones on the markets with you. Thank you so much.
Thank you. It's been an absolute pleasure and look forward to interacting with you, celebrating the next milestone for the market. Thank you very much for having me.
Wonderful. Okay. Well, 88 points higher on the Nifty, 25,240. Cannot be a better start to a series. Cannot be a better start to a weekend as well. So about a 0.3% higher move on the Nifty, a 0.5% higher move on the Nifty Bank. It's almost a 250 point of a jump on the Nifty Bank as well. So that's participating as well. 51,400 on your screens for the Nifty Bank. All the sectors are up into the green, viewers, and PSU banks are the latest ones that are actually taking the lead, over a percent higher for the PSU banks. PSU banks, pharma, realty, metals, they're all shining bright in trade. Oil and gas, banking space, they're all contributing. Look at the top movers on the Nifty. You have auto space as well. Hero MotoCorp as the top mover now. 2% higher. Remember, over the weekend we will be seeing the sales figures also start to pour in, and we will be checking that on Monday. For the monthly sales figures of the auto space, BPCL, Divi's Laboratories, Power Grid, Tata Steel, Titan, what a diverse range of top movers as far as the Nifty is concerned right now. We do have some draggers as well. So Tata Motors, after that 4.5% move yesterday, has slipped about 1%. LTI Mindtree, Bajaj Auto, Shriram Finance, Wipro, HDFC Life are some of those stocks which are still dragging. The PSE index is up by 0.5%. Of course, it's the energy basket, the power names that are again moving up in this space. Within the FNO, again, it's the sugar space stock that's leading the gains. Balrampur Chini has been in momentum for the last few trading sessions. Today, again, it's the entire sector-wide move that we have seen for you. Shell pointed all of those stocks that are up 8, 9, 10% higher in trade in the early morning trading session. We also have Bandhan Bank now coming up in FNO, Coromandel International, Oberoi Realty, Chambal Fertilizers are some of the other stocks that are top movers in the FNO space. On the downside, you have Voltas, Tata Motors, M&M, SBI Cars, Jubilant Foodworks and Cholamandalam Investment that are still down in trade right now. Broader markets, a slew of those sugar names, Dalmia Bharat, Magad Sugar, Triveni, you have Praj Industries, Dhampur Sugar, Sakti Sugar, or Sri Renuka Sugar, KCP. They're all upwards of 6, 7, 8, 20% higher in trade for some of them as well right here. Anything else, Shell, that you'd like to add?
Yes, Sakshi, and that is the volume buzzers that are coming into the Nifty 50. Remember, they are the most critical component when it comes to where the index is headed. At 9:57, which is less than 1 hour of trading, HDFC Bank has already traded 68% of its 5-day average volume, 1 crore shares, and it's in the green. Hero Motors has traded 57% of its 5-day average in the green at record high. Ditto Britannia, ditto BPCL, and coming back into focus is Bajaj Finance, ladies and gentlemen, now above 7,100. Remember, I had spoken about this stock. This might be the stock to watch out for the month of September. Beaten down, still not contributing anything to Nifty's total of year-to-date gains. And this is something that needs to be looked forward to. Let's look at the most active volume list. Already, as Sakshi had pointed out, HDFC Bank will be in focus. 1,700 crores worth of transaction is done. It's in the green. You have a very strong play coming into stocks that are at record highs. I wish to mark two, BPCL and HPCL. Remember, yesterday we had a very well-known sector analyst from ICICI Securities talking in very bullish tones about 2 or 3 stocks in that space. In order of appearance, Oil India, HPCL and GAIL, all of them are in green, and surprise, surprise, all 3 of them are at record highs. BPCL, I'd like to point out, 1.3% higher, again a record high, and amongst record peaks that we've set within Nifty, it's BPCL, Bharti Airtel and HCL Tech, and in the most widest index, which is NSE 500, taking it away is Balrampur Chini. Sweetness getting into the markets. EID Parry 850, fresh record high. Lupin we've discussed many times over the last 3 months or so. 2232. You have so many pharma names: Granules, Torrent Pharma, Alchem, Abbott India, and of course some other stocks. And Sakshi, let me just bring out a new one today, which is Patanjali, 1930, 0.5% higher. This, ladies and gentlemen, remember, is the rural theme. A lot of macro data is saying that rural demand is coming back. Therefore, you see moves on Dabur, you see moves on Patanjali, and you see moves on the biggest rural play in India, which is Hero Motors. Sakshi, that's all I have to say.
Okay, wonderful. 10 a.m. and the right time to end this wonderful show. But stay tuned on Business Today television. We will have a lot more to share with you in terms of insights from top market experts on the markets. There is new IPOs that are coming up, so stay tuned for that. 12 noon, I'll be back with another edition of Daily Call. So we'll be discussing that too. There will be a special KYC segment where we will be discussing one key stock in detail on that one too. So stay tuned for that, and we will be back, both Shail and I, at the closing hour of trade. Thank you so much for being with us on this edition.
Waterlogged streets, overflowing rivers, and extensive infrastructure damage. Gujarat is reeling under relentless rainfall. Vadodara, Jamnagar, Rajkot, and Saurashtra are among the worst hit areas.
राजकोट के कई जो इलाके उसमें जलभराव की स्थिति है वो देखने को मिल रही है और राजकोट का जंगलेश्वर विस्तार है।